Hello, welcome tonight to our webinar about managing your medical school student loan debt. This is Karna Sir, one of the ACRO committee members. We hope we have Jeff Witz tonight with us, who will present about this topic. Jeff is an educational program director and certified financial planner at MedQuist Asset Advisors, Inc. Mr. Witz specializes in wealth management and retirement plan services provided by MedQuist, focusing on retirement planning, investment consulting, student loan debt repayment strategies, estate planning, and asset protection. He is also responsible for reviewing physician and workplace benefits and assisting physicians around the process of changing employees, evaluating their new benefits package. With the firm since 2011, Mr. Witz delivers lectures across the country to physicians and coordinates all of MedQuist's educational programs utilized by hospitals and medical societies. So I will turn it over to him.
Hi, thank you for that introduction, and thank you for joining me on this webinar. Again, my name is Jeff Witz. I'm a certified financial planner and the educational program director at Medicus. Quick background on me: I've been with Medicus for about 5 years now. On top of giving webinars like this and giving lectures all over the country, I also service my clients' wealth management needs. That includes investment consulting, financial planning, retirement planning, asset protection strategies, estate planning. I also help physicians strategize how to pay off their student loan debt, which we'll talk about tonight. I also review probably about 100 different benefits packages a year for physicians who are either transferring employers or for residents and fellows who are maybe getting their first job offers out of their programs. Help them identify kind of the strengths and weaknesses of those plans and how to best take advantage of them. If anybody has any questions about any of that or are looking for any assistance with any of that, my contact information is on the screen. Please reach out to me. It'd be our pleasure to assist you in really any way that we can. A quick background on Medicus: we have been educating physicians for the last 30 years. We used to be the internal advisors at the AMA, and then about 20 years ago, our co-founders splintered off on their own, but we've always remained focused on educating physicians. Medical Economics has ranked us as one of the top financial advisors for physicians every year running since the year 2000, which is something we're very proud of, and physicians make up about 90% of our client base, so we feel like we're particularly tuned into the financial needs of physicians. Quick disclaimer I have to give: we are registered with a broker-dealer, Osdale Financial Partners. It does allow us to buy and sell securities and insurance products for our clients, but really that makes up a very small part of what we do. About 1% of our revenue is generated from that. Really what we do is we educate and advise physicians on kind of the full range of wealth management topics. So tonight we're here to talk about managing your medical school student loan debt. My hope is that at the end of this presentation you have a really good understanding of what types of loans you have, how they operate, and then also have a good understanding of all of the repayment strategies that are available to you. And hopefully, again, by the end of the presentation you've kind of got a roadmap in mind for how you're going to approach your student loan debt. With that, let's jump into the agenda. So again, I want to start with just kind of the basics. Make sure you understand the types of loans that you have and how they operate, how they accumulate interest, things like that. We'll then look at the various repayment options that are available to you, including some income-based plans that may be appropriate while you're still in residency or completing your fellowship. We'll then look at the various loan forgiveness programs that are available, really the big one being the Public Service Loan Forgiveness Program, and then we'll also discuss them that are specific to people who work in the medical professions. We'll then talk about loan consolidation and refinancing and discuss some of the strengths and weaknesses or advantages and disadvantages to doing those in terms of refinancing. And then we'll finally look at some of these strategies that we really recommend consistently to our clients for how to pay down their loans and kind of our preferred strategies. Again, I think we're going to ask that questions be submitted on the side there. At the end, we'll circle back and I'll do my best to answer as many of those as we can. So again, I just kind of want to start with painting a picture of the general student loan debt landscape or medical school student loan debt landscape. So the average medical school student comes out of their program with between $167,000 and $190,000 in student loan debt. 79% of physicians come out with over $100,000 in student loan debt, 43% with over $200,000, and 10% with over $300,000 in student loan debt. I'll be honest, the majority of physicians that I speak to, whether I'm reviewing their benefits packages or helping them strategize their student loan repayment plans, most of them have between $200,000 and $300,000 in student loan debt, so a little bit higher than these figures represent. And I think probably the highest I've seen it right now has been about $500,000 in debt. Why do we like to include these figures here? We found that physicians don't really communicate with one another. They don't talk to their peers or their colleagues about their levels of debt. It is a very private matter. But because of that, a lot of physicians think that their debt levels are uniquely high. And our hope is that by kind of presenting these figures, it relieves maybe a little of anxiety and lets you know that a good majority of your peers are in a very similar situation to yourself and are looking for ways to pay down their debt. So again, I want to start by kind of going through some of the different loans that you may have, make sure you understand the different types and how they operate. So a good majority of student loans are Stafford loans. These are loans that are made available to just about anybody for undergraduate, graduate, or professional degrees. Stafford loans can be subsidized or unsubsidized. It's important to know the difference between the two. Subsidized means that it's not going to start accruing interest until 6 months after you've left your program, whereas unsubsidized means that it's going to start accruing interest right away. Again, it's important to know whether your Stafford loans are subsidized or unsubsidized. If they are unsubsidized, it may be worth making some minimum payments even while you're still in school. Some other loans that you may have, a PLUS loan. These are generally given out to graduate or professional students. It could be also be given out to your parents. If you have one of these or if your parents have one of these, it's important to know the difference between them and Stafford loans. Additionally, Perkins loans are generally given out to students with a financial need. And then finally, consolidation or consolidated loans. These are, if you were to have, say, 3 or 4 different loans and combine them into one loan, those are typically referred to as a consolidated loan. Loans are generally made through one U.S. Department of Education program, and that is the Direct Loan Program. With the Direct Loan Program, you are getting a loan directly from the U.S. Department of Education. Oftentimes, they will then outsource that loan to a third-party loan servicer. So if you get a statement and it's got a different name in the corner, don't be surprised. Most of the loans are outsourced. Another type of program that used to exist was the Federal Family Education Loan. They stopped giving out these types of loan in 2010, so it's unlikely you've got one of these loans. We do see them on rare occasions, so I do typically like to keep it in the presentation. If you do have one of these loans, just be aware that it is now mandatory that you convert them to a direct loan, and there is a bit of a process for doing that. All right, so how is the interest calculated on your government student loan or public student loan? Typically starts by taking your outstanding principal balance. Your outstanding principal balance is the amount of the initial loan that was made to you. Oftentimes, this causes a little bit of confusion because there can be interest accumulation and your total account or loan balance could be higher than your principal balance. So for example, say you took out a $100,000 loan and with interest accumulation the total balance is now at $120,000. Just know that the interest is going to be calculated on the $100,000, not the $120,000. So it's only that original loan amount. So you take your principal balance and you multiply it times the days since your last payment. Typically that is 30 or 31 days, as most people pay off their loans on a monthly basis. You then take that times your interest rate factor. What's your interest rate factor? It is your annual interest rate divided by 365. Why 365? Well, it's important to know that your student loans are calculated using a simple daily interest formula, meaning that the interest is accumulating on your accounts daily, and so your accounts will reflect an increased balance most likely on a daily basis. So something to be aware of there. Just to give you an idea of some of the common interest rates that are out there, these are the interest rates for the federal Stafford loans currently. As you can see, they have come down a little bit in the last couple of years. For a long time, they were holding pretty steady for graduate and professionals at 6.8%. It is important to know what your interest rate is on your student loans, as it will have an impact on which strategy is going to be best for you moving forward. So how much of your payment goes towards the principal balance? Unfortunately, that's not something I can tell you. Each loan is different. Each loan service provider is different. We always recommend that you reach out to your loan service provider and find out exactly how much your payment is going towards paying down the principal versus just paying down the interest accumulation. All right, so now I'd like to jump into some of the repayment options that are available. Just pretty much everybody starts off on the standard 10-year repayment plan. The 10-year plan typically has a fixed interest rate, a fixed monthly payment amount, and is obviously paid off after 10 years. Oftentimes we get clients of ours calling us up and they've gotten their first student loan repayment notice from the loan service provider, and the number is kind of shocking. It's significantly higher than what they were anticipating or what they even feel they could comfortably pay any given month. Just know that you're not unique in that. A lot of people feel that anxiety when they first get that notice, and because of that, it's nice to know that there are some alternative repayment plans available to you. Probably the most used for a lot of our clients is the graduated repayment plan. Again, same 10-year window, but instead of it being a fixed payment amount, payments start at a lower amount early on and get higher over time. So we've had a lot of resident and fellowship clients who get on the graduated plan because the lower payments fit their income levels while they're still in their programs, and they can handle the higher payments later on. Just be aware that because the payments start lower, they do get significantly higher towards the end of that 10-year term. So be prepared for that high amount there. Additionally, you can get onto an extended repayment plan. These can be applied to either a fixed or graduated payment plan. What this does is it extends the repayment period from 10 years out to 25 years. The big advantage here is that it will significantly reduce your monthly payment amount. Obviously, the downside is you will end up accumulating and paying more interest over the duration of the loan. But it does have some advantages. By paying the lower monthly amount, you can free up some cash flow that can be used on other important things like saving for a home, saving for your kids' college education, or even saving for retirement at that point. Additionally, you may have the opportunity to participate in one of the income-based plans. These are generally for individuals with a financial hardship. However, typically physicians who are in their residency programs or fellowship programs do qualify for these. And so if you are in one of those programs, we would recommend that you explore these options. And even if you have left your program, we'd recommend that you explore whether or not this is something that you're able to get into. We have seen clients of ours who are fully practicing physicians making $200,000–300,000 a year who still qualify for an income-based repayment plan. Financial hardship is a little bit relative, and they base that really off of geographic location. So if you live somewhere that has a high standard of living or cost of living, you may still qualify for financial hardship. So even if you're out of your programs, worth looking into. Quickly, how they calculate your payment on an income-based plan, they take a percentage of your discretionary income. So really what they do is they take your take-home income, subtract out the cost of living formula, and what's left over is your discretionary income. Again, the cost of living is different based on geographic location. So if you're living in San Francisco versus maybe Topeka, Kansas, the calculation will be a little bit different. What they then do is they take what's ever left. They consider that your discretionary income. That's money that they consider kind of entertainment money, going out to eat, going to the movies, things like that. And they ask that you pay 15% of that discretionary income towards your student loan repayment amount. Additionally, they always require that if you're on the income-based repayment plan that you have a 25-year repayment schedule instead of 10. An additional option if you are experiencing a financial hardship is the pay-as-you-earn repayment plan. Eligibility for this is a little bit tough. You have to have taken out a loan and utilized that loan within a very specific window. So not many people qualify for this repayment plan, but if you do qualify, it's definitely a decent option for you to explore. Similar to the income-based repayment plan, they look at a percentage of your discretionary income, 10% instead of 15% of your discretionary income, and the repayment schedule is 20 years instead of 25 years, so slight difference there. Now, if you do not qualify based on financial hardship, there are some repayment plans that exist that are also kind of income and earning based, and that is the income contingent and income sensitive repayment plans. Again, these are based on kind of your take-home income and a percentage of your income. So even if you don't have a financial hardship, you may be able to reduce your payments through one of these plans. What we always warn, though, is pay attention to what your repayment amount would be under these plans, because sometimes the calculation can be higher than what you would pay under the standard 10-year plan, and if it's higher, it makes sense just to stay on the standard 10-year plan, so make sure to pay attention to that. To kind of demonstrate the impact of the different repayment plans, we always like to include these examples here. So in each one of these examples, you're starting with a $180,000 federal direct loan. And in scenario one, I always like to start with the basic standard 10-year repayment plan as a point of comparison, so that you can use that to kind of look at the other plans and see what the impact of those plans is going to be. So with the 10-year standard repayment plan, again, you're going to have the fixed payment of $2,700 a month. You'll pay that every single month for 10 years, meaning that over those 10 years, you will have accumulated and paid $148,000 in interest for a total loan repayment amount of $328,000. In the next example, this is the pay-as-you-earn income-based plan. Again, this has a 20-year repayment window. It's again going to be based on your income that you're earning, so the payments will fluctuate. I forgot to mention this, but with both the pay-as-you-earn and the income-based repayment plan, you will have to apply every single year for that plan or reapply for that plan. And if you've had any significant increases in your income or decreases, the amount that you will owe will be reflected there. So again, with the pay-as-you-earn 20-year repayment schedule, payments starting low and getting higher as your income increases. Over that 20 years, you will end up paying approximately $269,000 in interest for a total loan repayment amount of just under $450,000. Final example looks at the extended repayment plan. So again, under this repayment plan, you've got a fixed payment that you will make every single month for 25 years. As you can see, by extending the payment out to 25 years versus 10 years, you significantly reduce the amount that you're going to owe on a monthly basis. It drops it from $2,700 to $1,600. Again, if you can be disciplined and take that money that you're saving and put that towards saving for a home, college education for your kids, or even to retirement, it can really have a big positive impact on your financial success long term. But again, if over 25 years in this final example, you will end up paying a little over $300,000 in interest for a total loan cost of about $483,000. Now, a lot of times people look at these examples and they think to themselves, well, it's pretty obvious I need to put every available dollar that I have towards paying down my loan as soon as possible. While that may be the best strategy for you, as we'll demonstrate a little bit later, there are situations where the extended repayment plans can be extremely beneficial and maybe the right route for you to go. So next I want to jump into some of the loan forgiveness programs that exist. Probably the most well-known one is the Public Service Loan Forgiveness Program. This says that if you work for a nonprofit or 501c3 organization for 10 years and make the 120 required payments towards your loan over that 10-year period, any remaining balance that's left over on your student loans will be forgiven. We see a lot of physicians who especially have higher student loan balances, maybe in the $300,000, $400,000, $500,000 range, seriously consider going this route. You know, besides the benefit of having your loan forgiven, the period's relatively short. Most hospitals, or a good portion of hospitals, are nonprofits, so a good amount of them would qualify for this. Unfortunately, often private practices, or if you start your own practice, oftentimes they wouldn't qualify for these payments. Another thing to be aware of is oftentimes residency programs or fellowship programs are also done at nonprofit institutions. If that's the case, then if your residency program's 3, 4, 5 years long, then you can already knock off 3, 4, 5 years of this 10-year forgiveness route, essentially. It is important, though, to continue to make payments while you are in residency or your fellowship. And again, you can get onto an income-based plan that your payments can be, relatively low in terms of what you owe. So you can pay a relatively low amount for, 4 or 5 years, and then your payments will bump up once you're a fully practicing physician, but at least half of that 10 years was undertaken while you were on one of those income-based plans. Another one of the benefits of the Public Service Loan Forgiveness Program is any loan balance that is forgiven at the end of 10 years is forgiven tax-free, which is different than the 25-year loan forgiveness program, which we'll get into in a bit. So really, the Public Service Loan Forgiveness Program is a really great option, especially if you've got a lot of student loans and you're questioning how you're going to pay them off while also satisfying your other financial needs. So it is a really good route for people to consider. It is worth noting that they really hate forgiving your student loans. So keep really good documentation of all of your payments and your employment history throughout that whole thing, because they'll be looking to really poke holes in it in any way that they can. All right, moving on. If you join the Army National Guard, they will forgive up to $10,000 of your student loan. Not a huge amount, but always nice to get a little bit of benefit if you are putting in that time. These are loan forgiveness options that are available to people who work in medical professions. The U.S. Department of Health and Human Services offers loan forgiveness to physicians to agree to practice for a set number of years in areas that lack adequate medical care. The time period for that loan forgiveness can vary depending on where you are doing your practicing. It could be shorter than the 10 years. It could be longer. So it's just something to be aware of there. The U.S. National Institute of Health will repay up to $35,000 per year of your student loan debt if you are conducting clinical medical research. And then most states also offer some loan forgiveness programs, usually on a much smaller amount or smaller basis if you work in their public health sectors, things like that. So always nice to explore what programs are out there and what the forgiveness program is in the state that you're living in. If volunteering is something that's important to you and something that you do often, if you serve 12 months in AmeriCorps, they will pay $4,725 towards your student loans. If you go and work for the Peace Corps, volunteer for the Peace Corps, they allow you to defer payment on your Stafford, Perkins, and Consolidated loans while you are in Peace Corps. The big benefit there being that you don't have to pay the loans, the downside being that they still accumulate interest. If you are in the Peace Corps, they will forgive up to 15% of your Perkins loans for each year of service, up to 70% total of your Perkins loans. Finally, if you do volunteers in service to America and you volunteer for 1,700 hours of service, again, they'll pay you $4,725 towards your student loans. Obviously not a huge amount, and for physicians who maybe have $200,000 to $300,000 in student loan debt, you know, a relatively small drop in the bucket. But again, if volunteering is something that's important to you, it's nice to know that they'll at least be paying a little bit something towards your loans. Finally, for every government or federal student loan that's been made, every loan is forgiven after 25 years as long as you have made all the requisite payments over that 25-year period. So similar to the public service loan forgiveness program, you have to make the 120 required payments. In the 25-year forgiveness program, you have to make every monthly payment for 25 years. Something to be cautious of if you are planning on going the 25-year forgiveness route is any loan balance that's forgiven is included in taxable income in the year it is forgiven. So if, say, you have a $30,000 loan balance at the end of the 25 years, that gets included in your income that year, you're going to be taxed on it, and it may even bump you into a higher tax bracket. So something to pay attention to. One of the nice things is because it will be a relatively significant tax hit in that year, the IRS does allow you to get on a payment plan at fairly low interest rates to be able to pay that off over time. They do offer some tax breaks for repaying your student loans. The first $2,500 of the interest that you pay towards your student loans are deductible. However, be aware that there are some fairly low income phase-outs for this deductibility. So if you are a single individual and you make between $60,000 and $75,000 a year, your ability to deduct that $2,500 starts being phased out. And if you make over $75,000, you're no longer able to deduct that $2,500 at all from your taxes. Married, the phase-out starts at $120,000 and then is completely phased out at $150,000. So some of you may be looking at this and saying, well, as a fully practicing physician, I'm not going to qualify. Again, if you are in your residency or doing your fellowship currently, you know, this is something you may be able to take advantage of depending on how much you're earning. Obviously, again, it's not a significant amount, but every little bit helps. So a common question that we get is, should I consolidate my loans? And there are some advantages and disadvantages to doing so. Really, the big benefit to loan consolidation is really just simplifying your loan. You know, instead of having 3 or 4 loans with 3 or 4 different loan service providers and each one's got a different due date and a different due amount, by consolidating you can bring it all under one umbrella. You know, one loan, one interest rate, one payment amount, one date. So it really can simplify everything. Now, if you decide to consolidate with a private loan servicer, you can potentially lower your monthly payments. By consolidating, you may be able to, again, extend the payment period out to 25 or 30 years. Again, that'll lower your monthly payment amounts. Additionally, you may have access to some alternative repayment plans. So if, again, typically the private loan service providers have a little more flexibility in terms of what they can offer you, so you may be able to find something that fits your needs a little bit better. Disadvantages, obviously by extending out the payment period, you will end up paying more interest over time. Additionally, you may lose some borrower benefits. So if you took out a loan through a private student loan provider, oftentimes they provide some incentives for taking out a loan through them, and by doing so, by consolidating, you may lose some of those benefits that were offered. Some common questions we get about loan consolidation: can I consolidate private education loans with public education loans? The answer there is it depends. If you are trying to consolidate through a government loan service provider, typically you cannot bring in a private loan. However, if you are consolidating through a private avenue, then oftentimes you can bring your government loans and consolidate them together with the private loans there. Another common question is, can a PLUS loan made to a parent be transferred to the student through consolidation? Unfortunately not. A PLUS loan is made out to your parent, and unfortunately you can't consolidate that into your own loans. What is the interest rate on a consolidation or consolidated loan? The interest rate is essentially the weighted average of the interest rates. So say you have a $10,000 loan that has a 4% interest rate and a $10,000 loan that has an 8% interest rate. Your weighted average combined interest rate there is going to be 6%. Additionally, there's no cap on the interest rate. Oftentimes we'll have physicians contact us asking if they consolidate, can they get the new lower interest rate, say for the Stafford loans. Stafford loans now interest rates are like 5.82 or 5.84%. And so they think by consolidating they can get that lower interest rate. Unfortunately not. It's always going to be the weighted average of the interest rate. So again, if you have a $10,000 loan with, say, a 6% interest rate and a $10,000 loan with a 10% interest rate, that consolidated weighted average loan interest rate is going to be 8%. So you're not going to get that 5.84% rate that they're now offering. So really a really common question, and one that's often asked, is should you refinance your loans? And again, it kind of depends. There are some advantages to doing so. Really the biggest advantage to refinancing your student loans are you can have significantly lower interest rates. I've had clients who had 8% interest rates on their government loans be able to refinance and get about 3% on their loans. So it can significantly reduce the interest rate. Obviously, the rate at which you will be offered through a private refinancing company will be dependent on your level of income as well as your credit. When determining whether or not to refinance, it's important to kind of look into your crystal ball and think, where will I be in the next 10 years? If you see yourself working for a nonprofit hospital or a nonprofit organization, then refinancing is probably not the best strategy for you. Again, if you are going the nonprofit route, the 10-year forgiveness program is really excellent and something you should probably strive for. By refinancing, you're essentially turning the loan into a private loan, and you lose a lot of the protections that come along with those government loans. So again, if you think you're going to go the nonprofit route, refinancing probably doesn't make sense. If you think that you're going to work for a for-profit hospital or a private practice or strike out on your own, then refinancing absolutely is something you should consider. Again, the lower interest rates mean you'll pay significantly less over the lifetime of the loan. Again, some of the disadvantages to refinancing, and I kind of touched on this, the loans become private, so you do lose protections. If you ever were to become disabled, or say you change jobs, but your new job you earn significantly lower income. If you had a government loan, you would be able to still get onto an income-based repayment plan that still at the very least has the 25-year forgiveness option. If you refinance, unfortunately you're going to lose most of those protections. Again, you're essentially turning the loan into a private loan similar to a mortgage. So you lose a lot of the ability to go onto the income-based plan. You lose the ability to go back onto the public service loan forgiveness route. Additionally, with public loans, if you are to die while still having an outstanding loan balance, that loan balance will be forgiven if you have a public loan. If you've refinanced to a private loan, we've kind of seen it both ways. Some companies have started keeping that loan forgiveness contingency, so if you were to die, the loan still gets forgiven. Other loan service providers or refinancing companies don't have that same provision. So something to keep in the back of your mind and pay attention to if you are thinking refinancing is going to be the best route for you. Additionally, when you are refinancing, typically the idea is to free up some additional cash flow. it's really important to stay diligent in that you take that extra cash flow and you invest it or save it for your financial goals, and don't use that cash flow to maybe spend frivolously on some luxury items. If you are refinancing, it makes sense to invest that money if you think that you will earn a higher rate of return than whatever your interest rate is on your refinance loan. If you don't think you'll get a higher rate of return on your investments than what the interest rate is on your loan, it makes sense to pay extra towards your loan instead. All right, so finally here I kind of want to get into our preferred strategies that we really recommend to the majority of the physicians that we work with. I'll just start really basically with some kind of basic concepts that everybody should be doing, really, no matter where they are at in their loan repayment strategy. The first one is simply living below your means. If you can, instead of going out to a bunch of nice dinners, and instead kind of save that money instead and put it towards your student loans or put it towards your savings goals, it can really have a significant impact long term. Kind of going along with that, set a repayment goal that's above your required payment amount. If you were able to pay more towards your loan, there's a good chance that that goes towards paying down your principal at a faster rate. As I say that, it's important to know that if you're on one of those income-based repayment plans for financial need, your payments may only be making up a portion of the interest accumulation. You may not even be eating into your principal yet, so applying more money to your payment still may not touch the principal. You may just be eating up the rest of your interest accumulation there. Finally, make your payment automatic. I can't tell you how many of our clients have called us and told us that they missed a payment just because it slipped their minds. Generally, it's not a huge deal anymore, but if you are going for one of those loan forgiveness routes, as I mentioned, they're really looking for anything to prevent you from getting that loan forgiveness, and missed payments is definitely something that they look for. So again, make your payments automatic. Most of the loan service providers now have it set up where you can link it up with your bank account and they'll just take out your payment amount automatically each month, so it's not something you have to worry about. All right, so again, I always like to start with that standard 10-year repayment example. Again, it's a great point of comparison to show the difference in the impact. So in all the examples going forward, we'll be talking about a $100,000 student loan. But in the 10-year example here, fixed interest rate at 6.8%, a repayment period of 10 years, your required minimum payment amount is going to be $1,150 per month, meaning that over the duration of those 10 years, you're probably going to pay about $38,000 in interest for a total loan repayment cost of about $138,000. Now, a lot of the physicians that we speak to, their loans give them a lot of anxiety. It keeps them up at night. It prevents them from doing their responsibilities at work the next day or when taking care of the family. And so in situations like that, it makes sense to contribute more money to paying down your loans at a faster rate. So in this alternative scenario, this physician has anxiety about their student loans, has an extra $300 per month in cash flow, and decides to commit all of that $300 towards paying down their loans at a faster rate. So now their payment is $1,450 a month instead of $1,150 per month. What's the result? Well, the loan will be paid off at a faster rate. The loan will be paid off in 7 years, 4 months instead of 10 years, and you'll save yourself approximately, or a little under $11,000 in interest. So it is a really good option, and one that we do recommend fairly often. But what is the downside of this strategy? What's the downside of throwing all of your money towards your loan? Really, it's that you're not saving anything for your other important financial needs. Again, saving for a house, saving for your kids' college education, saving for retirement, and really anywhere in between. So you can really be putting yourself at a disadvantage by putting all your money towards your loans. And in this next scenario, we kind of want to illustrate how that typically plays out. So again, we've got the $100,000 outstanding loan, but let's say that this physician has a goal of retiring 30 years after residency. So they're making that $1,450 per month loan payment. The loan's paid off in 7 years, 4 months. That means that they now only have 22 years and 8 months to save for their retirement. So now they take the money that they were putting towards their student loans, that $1,450, and now they start investing it. Assuming a 10% rate of return after taxes, this physician will have accumulated just under $1.5 million in their retirement account. Now, $1.5 million is certainly nothing to turn your nose up at, but it's less than if you had been able to find some sort of balance where you paid off your loans while also simultaneously saving a little bit. And that's really where I want to get into next. Can you have your cake and eat it too? Can you save for retirement while simultaneously paying off your student loan? So again, this is really a strategy that we advise physicians who are comfortable carrying their loan balance. They don't really have a whole lot of anxiety about their loans. They're okay maybe carrying them for 25, 30 years like a mortgage. Again, if you have that anxiety, by all means, put more money towards your student loans and try and pay them down at a faster rate, or at least pay them down until you reach a level that you're comfortable with and you can actually sleep comfortably at night. But again, this strategy, and really our preferred strategy that we recommend most often, is for physicians who are comfortable carrying the debt. So what's the strategy? First, you consolidate and refinance your loans. Obviously, the benefit is you simplify your loans, and through refinancing, you're able to significantly reduce your interest rate. Again, this is a route for those who are going to be working for a private practice or a for-profit hospital for themselves. Really, again, this isn't the strategy if you're going that public service loan forgiveness route. But if you are working for the private company, consolidate, refinance your loans, get that lower interest rate. We recommend extending out your repayment period to 25 or 30 years. Again, that's going to significantly reduce the amount that you're going to owe on a monthly basis. So again, using that same $100,000 example, if we refinanced and increased the loan payment period to 30 years, our new required payment is $652 a month. Obviously, that's significantly lower than the $1,450 per month you were paying in the previous example, and less than the $1,150 you were paying in the initial 10-year standard repayment plan. So what does this do? This opens up a lot of cash flow for you, and really the strategy here is you have to be disciplined in terms of not spending this extra cash flow and instead saving it and investing it for your retirement, your purchasing a home, important financial goals like that. Again, it's really important to be disciplined. If you are just getting the extra money to spend, really this isn't an appropriate strategy for you. So what's the impact here? So again, with that same retirement goal of retiring 30 years after residency, investing approximately $800 per month every single month, starting right out of residency, so you're not waiting that 7 years, 4 months before your loan's paid off. You're investing right away. Assuming a 10% rate of return, you will have accumulated approximately $1.8 million in your retirement account. So some additional retirement savings of about $300,000. So again, this is a great way to simultaneously pay your loans while saving for retirement, and it really can have a big impact in terms of your retirement accounts later on in life. But again, this is the strategy for individuals comfortable carrying their loans. If you, again, have anxiety about your loans, paying off those loans at a higher rate absolutely makes sense. To kind of further emphasize the impact of paying off your loans while simultaneously saving, I always like to include this example here. So in this example, we've got two people, Michelle and Barack. Both of them are age 27. Both of them are just coming out of their medical school programs. Now Michelle, she's a saver. She decides that she wants to start saving into her IRA. So she starts contributing $5,500 into her IRA every single year for 9 years until age 36. Now, coincidentally, $5,500 is the most that you can contribute into your IRA every year. At age 36, she decides that she's done contributing to her retirement account completely, and she's just going to let it grow using interest and compounding interest. Barack, on the other hand, he's got a lot of student loans. His loans are giving him a lot of anxiety. He decides that he wants to put all of his additional resources towards paying down his student loans as quickly as possible. So he doesn't start saving for his retirement until age 36, the same age that Michelle stopped contributing to her account completely. Barack then contributes $5,500 every single year for 29 years, all the way until he reaches retirement age 65. What's the result? Well, Michelle's contributed a little under $50,000 into her IRA over that 9-year period. Barack has contributed over 3 times that amount at almost $160,000 into his IRA over that 29-year period. What's the result when they both reach retirement age? Well, sometimes it surprises people, but Michelle actually has accumulated more assets in her retirement account by age 65. This is the beauty and the power of compounding interest, which is afforded to those who can start saving and investing early. If you think of compounding interest as a snowball, the snowball, as it starts rolling, starts gaining momentum and growing in size. If you can start getting that snowball moving earlier, it can grow in size and really pick up steam by the time you're reaching your financial goals like retirement, and hopefully by the time you're in retirement, that snowball is really just moving on its own and churning out income for you. Now, again, why do we like to include this slide in the presentation? Well, we recognize a lot of you have anxiety about your student loan debt. We hope that this slide kind of illustrates that if you can find a balance, if you can start saving for your retirement while simultaneously paying down your student loans, it can really have a significant impact, and the sooner that you start doing that, the bigger impact it can have long term. So in conclusion, I always like to review your repayment options. Again, the first one is your standard 10-year repayment plan. You're going to have a fixed monthly payment amount, a fixed interest rate, and it'll be paid off after 10 years. Next is the extended repayment plan. So this is extending it from 10 years to 25 years. Obviously, the big benefit is it will significantly reduce your payment amounts. Again, if you can be disciplined in using that freed up cash flow to save for your financial goals, it can have a really big impact. Again, the downside is you will end up paying more interest over time. But again, as long as your investment returns are higher than the interest rate on your loan, then you'll be gaining in terms of the long term there. Next, the income-based plans. Again, really great if you are in residency or still in your fellowship. The payments will be significantly lower, and they all count towards your 10-year public service loan forgiveness route if that's the route you want to go. In general, it's just a good way to pay the loan while you're still not earning that much. We hear a lot of physicians who consider loan deferment. We typically don't recommend that unless absolutely necessary. Again, during deferment, you don't have to pay, but you will, the interest does still accumulate on the account, and it can get fairly significant throughout the duration of your residency and fellowship programs. Next, you can consolidate your loans. Really, the big benefit here is just simplifying what your payments are and who you're paying. It just really makes everything a lot easier. You can refinance your loans. Again, this is something we would recommend to any physician who's not going the public service loan forgiveness route. It makes sense to just lower your interest rates if it's available. And then also just be aware that you will lose some of those protections. You won't be able to go back to the income-based plan if you become disabled. You won't be able to get the loan forgiveness either through the public service or the 25-year route. And the loan won't be forgiven if you end up dying, in most cases. Again, some companies have started keeping that provision in there. Sixth here, pay above your required amount. Again, this is the strategy for physicians who have high balance amounts that are maybe giving them a lot of anxiety. By all means, and again, your mental health is most important. Put the money towards your loans and at least get them down to a level that you're comfortable with and aren't providing you so much anxiety. Last here, and again, this is kind of our preferred strategy. If there's one that we'd hope that physicians would be able to do, it's going this route, and that is consolidating and refinancing your loans. Again, reducing the interest rate, extend out the repayment period from 10 to 25 to 30 years. Again, that'll significantly reduce your monthly payment amounts. It'll open up a lot of additional cash flow that hopefully you're disciplined in putting that additional cash flow towards your financial goals, like saving for retirement, purchasing a home, or saving for your kids' college education. That's all I got for you guys today. Thank you so much for listening. I'll leave you guys with my kind of favorite comic on student loans, and I'll take any questions that may be out there.
All right, so if you have any questions, please ask in the question box. So far we have three questions, so I'm going to ask them to you. So is there a cap amount on the public loan forgiveness amount?
No, there is not. So,
loan forgiveness amount.
Everybody hear me okay?
Yep.
No, there's no caps on the public service loan forgiveness amount. That's why we see a lot of our clients who have higher balances really go that route. It's a really excellent route to go. Especially if you had been paying your student loans in residency, you're already maybe 3, 4, 5 years towards that 10-year goal, and so making payments for another 5 or 6 years before having potentially $300,000 in student loans forgiven is a really nice route to go.
Okay, and I don't know if you covered the public service loan forgiveness. Do you have to pay taxes on it when the amount that's forgiven?
Yeah, so this is often a common misconception because the 25-year forgiveness route, you do have to pay taxes on any forgiven amount. The public loan service forgiveness amount, you do not owe any income taxes on for that forgiven amount. So again, it's a really, really excellent benefit, a really excellent route to go if you've got a higher loan balance.
Okay, so does refinancing your loan change the tax deduction limit of $2,500 per year?
I don't believe so. That's something I would have to check into a little bit more. But again, typically, if you're refinancing, it's because you're going into into a private practice or a for-profit hospital, and most likely as a physician, you will be earning above those income phase-outs. So most likely the deduction won't be available to you. Typically, we don't recommend that physicians refinance while they're still in their residency or fellowship programs. Again, it's really hard to look into your crystal ball and think where will you be at in 5 years, 10 years, and what kind of job opportunities will you have outside of your programs. Who knows? You may end up going and working for a nonprofit. So you don't want to kind of take the opportunity of going that public service loan forgiveness route away from you by refinancing while you're in residency.
And then regarding the 10-year public service loan forgiveness, if your provider decides that they give you a break or they skip a payment because they're recalculating your monthly income, does that disqualify you from the loan forgiveness?
No, my understanding is even a missed payment won't disqualify you from the forgiveness. Though they may make you make some additional payments, but overall it won't disqualify you. What I would recommend is that if anybody is interested in exploring the public service loan forgiveness route, that there's a form on, I believe, studentloan.gov that you should fill out and complete for your employer. It'll let you know and ensure that your employer qualifies as a public service organization. But in terms of missed payments, my understanding is that it won't disqualify you.
Okay. And I think that's it. Thank you so much for your
It's
talk. I
my
appreciate it.
Yeah, it's my pleasure. Again, if anybody has any additional questions or would like any more information about financial planning topics, by all means, reach out to us. We'd be happy to speak with you and find out how we can help you.
All right. Thank you.